Mortgage interest rates are on the move. Are you interested? If so, stick around. We're going to talk about that and a bunch of other data coming up next. Hey friends, Ryan Reynolds here with Keller Williams Consultants Realty with your August 2025 real estate market update. So this month we're going to talk about the same three things we talk about most months, which are inventory levels, mortgage interest rates, and of course pricing, which is what interests most people. And we're going to jump into inventory starting now. Today on the MLS there are 4,374 single-family homes on the market. Now that's up from 3,227 last year, and that represents a little over a 35% increase. Now of that 4,374, 520 of those homes are new construction, which is about 12% of the total number of houses on there. And this year to date, we're up about 8.7 or 8%, I should say, more new listings coming onto the market. What does that mean? Well, because those numbers are like they are, that means that houses are taking a little bit longer to sell. Average days of the market right now is 23 days. Last year it was probably closer to 12 or 15 days, so our days on market take a little bit longer, but we're still under 30 days on market. And when you combine those statistics, what you get is an absorption rate or a months of inventory, and right now we're sitting at 1.7 months of inventory. 1.7 months is still in the seller market range. Typically what we consider a seller's market is anything below 4 months. 4 to 6 months would be a balanced market, and anything above 6 months would be considered a buyer's market. So we're a long way from buyer's market territory, but it kind of feels like a buyer's market because we came out of a market that was really strong seller's market. And so this is a weaker seller's market, which causes it to feel maybe more like a buyer's market. But in any case, 1.7 months of inventory, up 35% from last year, and that is inventory for this month. Now the next thing we're going to talk about is mortgage interest rates. And mortgage interest rates are really interesting this month, and I'm going to go a little bit in depth, so try and stay with me if you can. So the past few months, mortgage interest rates have been doing almost nothing. They've been bouncing between like 6.7 and 6.9%, and really haven't moved a whole lot. This month, they actually moved down to 6.58% just last week, probably in the last 4 or 5 days, actually. And the reason for that is twofold, I guess. Number one reason is the Federal Reserve had their meeting and they said they're not changing interest rates, but 2 of the directors actually, or the board, members of the board, dissented and wrote public opinions about why they should be reducing interest rates sooner, and that lends more credence to the fact that people think that they're going to reduce them in September, probably 0.25%. So that was one factor. The second factor that came out last week was that the jobs number came out way worse than they were expecting, and in fact they adjusted down the jobs number for the previous 2 months. So the jobs market is not as good as people were expecting it was based on the numbers that were being reported. Now that said, I want to talk about the 3 things that really affect mortgage interest rates in a big way. The first one is the Federal Reserve. Now, and we expect them to probably reduce that 0.25% here in September, and probably another 0.25% maybe somewhere in the November-December timeframe. And then so by next spring, we're probably expecting them to have done 2 reductions. That would result in about a 0.5 point total reduction, which a quarter of that is probably already factored into that 6.5. But anyway, figure about a 0.5 point from that. Now, 2 other things affect the number that we pay for a mortgage. One of those is the spread between the 10-year Treasury note and the 30-year fixed mortgage. So literally, it's just the difference from what the mortgage is at 6.58 to what the 10-year Treasury note is. And today that spread is 2.356%. Now, historically, that spread is 1.7%. But it goes up when there's more risk in the economy, or when people view the economy as being more unsettled. It happened in 2008, happened during the savings and loan crisis, and now in the high inflationary period of post-COVID, it's happening now. So with that spread at 2.356, that actually peaked out around 3%, maybe 3.1% at one time, and it's been floating down. Now historically, whenever the spread has gone up that high, it's come down really fast. This time it's kind of coming down more slowly and gradually, and we kind of expect that to continue on as things in the world get settled. Now, the third sort of factor that affects interest rates is what the Federal Reserve is doing with buying or selling mortgage-backed securities. And whether they're buying them or selling them, it's either called quantitative easing or quantitative tightening. And what that really means is that the Federal Reserve has a lot of mortgage-backed securities on their balance sheet. In fact, back in 2022, they had around $9 trillion worth of mortgage-backed securities on that balance sheet. Now, since that time, they've been gradually selling them on the open market and reducing their balance sheet with the target of getting to around $6 trillion worth of mortgage-backed securities by around February of 2026. Now, as they've been doing that, what that does when they're selling mortgages on the market to investors is it has the effect of raising interest rates or putting pressure on mortgage interest rates for people who are originating new loans, because there's more competition. So in order to compete, the banks have to charge more so that they can sell them. It's a little bit counterintuitive. Just know that this quantitative tightening period was likely going to be ending in February of 2026. So what happens when we combine all three of those factors? The Federal Reserve reducing the rates by a couple of instances at about 1/4 to 0.5%, the spread potentially tightening up as people become more comfortable with our economy, and the quantitative tightening ending. Well, I put all that into ChatGPT just to kind of get some reasoning and go back and forth. We had a couple arguments, but we kind of came to the agreement that probably the effect this is all going to have is that by mid-spring next year, interest rates could be about 1% lower than where they are now. Now, I don't know if that's the right number exactly or not, but if it does come down 1%, that would put interest rates for mortgages in around the 5.5% range. And what does that mean? Well, that means that there'll be a lot more people who are able to buy houses, which will produce an additional bunch of demand. And so if you are selling a house, you'll probably be back in that super seller's market next spring. That's great if you're only selling a house and planning to rent. If you're actually planning to buy another house, or if you're only buying and not selling something, that's awful news, because what it means is that you're going to have a lot more competition next spring, and so your opportunity to buy is probably right now. Between now and probably February, you can get into a house with negotiating with a seller, maybe not having to bid, and maybe even getting a reduction in price or getting some sort of concessions. And next spring, I have a feeling that that's probably all going to go back away, and we'll be back into a crazy time. My personal projection is that because of that, we're going to see pricing go up around 6 to 7% next year. And so we can go back at this video next year and look and see if I was right. Speaking of pricing, let's talk about pricing from the past year. So right now, the average sold price on the MLS is $393,000, and that is up from $386,000 last year, representing a year-over-year, month-to-date, or for July, I should say, of a 1.8% increase. That's pretty modest, but when we look at what's going on year to date, so from the beginning of the year to now, we're sitting at 4.4% increase, and that is a little bit above, about 10% above the average of 4%. So I know this month I was pretty heavy in statistics and pretty heavy in a lot of different factors that are affecting things. If you have questions about your specific situation and want to know how you can take best advantage of today's market, reach out and we'll set up a consultation where we'll develop a strategy just for you. Again, my name is Ryan Reynolds with Keller Williams Consultants Realty, and as always, it's the Ryan Reynolds team guiding you to the home that fits your life.